This is chapter 3, and first of all we have to answer the objective type questions. Hence, in this objective type questions, the answers are given. There are 4 alternatives and we have to select the correct alternative. Hence, chapter 3, change in profit sharing ratio among the existing chapters is the name of the chapter, and answers are there. Select the correct alternative. And first part, in the working notes, you see X and Y shared profits and losses in the ratio of 3:2. With effect from 1st April 2016, they agreed to share profits equally, 1:1. The goodwill of the firm was valued at 60,000. The necessary single adjustment entry will be, there are 4 alternatives. In the working notes, old ratio of X:Y 3:2, new ratio of X:Y is equal to 1:1. That is, we have to find out sacrificing ratio, old ratio minus new ratio. Excess sacrifice, old share minus new share. Old share is 3/5, new share is 1/2. That is equal to LCM 10, 6 minus 5, that is 1/10, sacrificing share of X. Y sacrifice, old share minus new share. Old is 3/5, new is 1/2, that is equal to LCM 10, 4 minus 5, that is equal to minus 1/10. This is gaining share. First was sacrificing, second one is gaining. Hence, X will get for goodwill. Goodwill is 60,000 and 1/10 is the sacrifice of X. That is rupees 6,000 for his sacrifice. X will be getting and Y will be giving, and Y will give for goodwill, that is rupees 60,000 multiplied by 1/10. His share of gain, that is 6,000 for his gain. Hence, Y's capital account debited to X capital account. The gainer will give to the sacrificer. Hence, Y's capital account debited to X capital account. This is part A, that is fair notes. Part A is the, out of these 4 parts, A is the answer. Debit Y and credit X with rupees 6,000. Next one is 2. We have to read the answer. X, Y and Z are partners sharing profits in the ratio of 5:3:2. They decided to share future profits in the ratio of 2:3:5 with effect from 1st April 2016. They also decide to record the effect of following revaluations without affecting the book values of assets and liabilities by passing single adjusting entry. Hence, we have to first make a revaluation account. This is second part of select the correct alternative. That is 2 working notes. Old ratio of X:Y:Z is equal to 5:3:2. New ratio of X:Y:Z is equal to 2:3:5. Sacrificing ratio is equal to old ratio minus new ratio. Then excess sacrifice, old share minus new share, that is 5/10 minus 2/10. LCM is 10. 5 minus 2 is equal to 3/10, that is sacrifice. X is sacrificing. And Y is sacrifice, old share minus new share, that is 3/10 minus 3/10 is equal to 3 minus 3/10 is equal to 0/10. No sacrifice or gaining share. Then Z sacrifice is equal to old share minus new share, that is 2/10 minus 5/10, that is equal to LCM 10. 2 minus 5, that is equal to minus 3/10. Z is gaining. Therefore, we have to prepare a revaluation account with a particular rupee symbol in both debit and credit side. I have not written by mistake debit and credit. Here, land and building is increasing by 1,50,000. By land and building, increase in asset will come in the credit side of a revaluation account, because this is a gain to the firm. Likewise, trade creditors is decreasing by 15,000. Third item, by trade creditors, increase in asset and decrease in liability is credited to revaluation account. And in the debit side, we will have plant and machinery decrease in value by 30,000. To plant and machinery 30,000 because this is a loss to the farm. Outstanding rent is increasing. Increase in liability is also a loss to the farm. Hence, the difference is 45,000 to outstanding rent 45,000. Now total the credit side we have rupees 1,65,000. Write down in the debit side, find the difference. This difference is 90,000. To revaluation profit, we have to pass one adjusting entry. It is gaining to sacrificing. Hence, X will get for revaluation profit, that is rupees 90,000 multiplied by 3 upon 10. X is sacrificing, that is rupees 27,000 for his share. And Z will give for revaluation profit, that is rupees 90,000 multiplied by 3 upon 10, that is rupees 27,000 for his gain. Now, fair notes. Z's capital account will be debited. This is A part. Debit Z and credit X with 27,000. Debit Z and credit X with rupees 27,000. It is gaining to sacrificing. It is gaining to sacrificing. Next one is third part. Here third part. A, B and C are partners sharing profits in the ratio of 5:3:2. They decide to share the future profits in the ratio of 2:3:5. What will be the accounting treatment of workmen's compensation reserve appearing in the balance sheet on the date when no information is available for the same? When there is no information, workmen's compensation reserve will be credited to partners in old profit sharing ratio. Hence, this will be the answer, third part C, distributed to the partners in their old profit sharing ratio in the credit side of the capital account. That is, C part will be the answer, distributed to the partners in their old profit sharing ratio. Then fourth one is A, B and C share are partners sharing profits in the ratio of 5:3:2. They decided to share future profits in the ratio of 2:3:5. With effect from 1st April 2016, they also decided to adjust the following accumulated profits, losses and reserves without affecting their book values by passing an adjustment entry. Book figures are given. Here we have to prepare in the working notes calculation of net adjustable amount with particulars and amount column. This is in the working notes. We have profit and loss account rupees 15,000. We have general reserve rupees 60,000. We have a loss. Advertising suspense account minus 30,000. We will be getting net adjustable amount rupees 45,000, which is to be taken for consideration for calculating the journal entry, passing the single adjusting entry. Then old ratio of A is to B is to C is equal to 5:3:2. New ratio of A is to B is to C is equal to 2:3:5. Sacrificing ratio is equal to old ratio minus new ratio. A's sacrifice is equal to old share minus new share. That is 5/10 minus 2/10. That is equal to 5 minus 2/10 is equal to 3/10. Sacrificing share. Then B's sacrifice is equal to old share minus new share. That is 3/10 minus 3/10 is equal to 3 minus 3/10 is equal to 0/10. No sacrificing or gaining share. C's sacrifice is equal to old share minus new share. It is 2/10 minus 5/10, that is equal to 2 minus 5/10, that is equal to minus 3/10. This is gaining share. Hence, A will get for net adjustable amount, that is rupees 45,000 multiplied by 3/10, that is rupees 13,500 for his sacrifice. C will give for net adjustable amount, that is rupees 45,000 multiplied by 3/10, that is rupees 13,500 for his gain. Hence, C's capital account debited to A's capital account will be the answer. This will be part A. Debit C and credit A with rupees 13,500 each. In the fair notes, A part will be the answer. debit C and credit A with rupees 13,500. And this is the final answer of the first type of questions, that is called select the correct alternative.